Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. And at the point of time that we are in, it becomes apt to understand what the portfolio strategy could be or should be, and what is it that some of the better performing fund managers are doing with their clients' money in order to generate the kind of returns that they are. Sameeksha Capital manages about 750 crores, and over a 3-year period, they have delivered a return CAGR of a whopping 41%. So they've done something right. The idea to figure out from Bhavin Shah, who's the founder and the portfolio manager at Sameeksha, is to try and figure out what is he and his team thinking of the current times, and are they altering their portfolio strategy? And if so, what is it that they are doing? Bhavin, great having you. Thanks so much for joining in. Hope all is safe.
Yes, thank you. Thank you for asking.
So Bhavin, that's a simple question. There are 2 or 3 key uncertainties, the latest virus variant notwithstanding. You also have the overhang of maybe a taper tantrum, as well as possibly rising interest rates, as long as the variant doesn't bring the yields down and inflation under control. What is it that you are thinking about the portfolio, and is it different from what you were thinking about it a month ago?
I think yes, you are right that while we have been primarily, if there are things to be concerned about, obviously when the markets have been in kind of a frame that we have been in, for many months, year and a half essentially, there is obviously a concern about especially the valuations and what could go wrong with this market. So and when we think about that, obviously the most obvious risk or concern that we have been dealing with is that of the inflationary pressures that have been building in global economy. And in this case, even US is no exception. Other parts of the world, and how if the central banks have to react in a more of a kind of a panic fashion to manage the manage inflation. Now, that concern has always been there, and that's why we have our strategy has been to not really chase stocks, even if the business near term looks good, or also to think kind of beyond next 6 to 12 months and see what is really sustainable and what is not. So essentially, that has resulted in maybe some bit of an increase in the cash levels in our portfolio. Maybe closer to between 15 to 20% is where we are currently. And so what has happened is that some stocks which we felt have done a lot, and maybe we should be a little bit more taking some risk off table. So we have pruned some positions because of that, and that is a result. And at the same time, we haven't found compelling reasons to buy a lot of new stocks, and so that is natural. That has resulted in a natural increase in the cash level, as opposed to doing like a big market call and saying I just want to be very, very safe, because the fundamentally, especially if you talk about the Indian economy here, I think the economy is in a very good has seen a very good momentum in the last few months. And our earnings also, which is a far more important thing for for the markets, corporate earnings have been very strong. So we observed that the market, the price to earnings multiples or the price to book multiples, they haven't expanded per se in last say 6 months. They have because the earnings have played a bit of a catch up, and the outlook, I think broadly looked pretty okay. I mean, I think so that has been our thought process. Now, obviously, market can correct because of unknown factors, and then suddenly now this COVID concerns have popped up again. And to be honest, we haven't really reacted to that yet. I think we are watchful of that. And I think we have not seen any kind of early signs of alarm in India per se, as to how it could affect the economic activity in India. So we haven't reacted to that, but we have to watch for how this evolves and what happens in India.
So Bhavin, since you're not taking a market call, but it's more driven by valuations of individual themes, as the case may be, I presume that even before this whole um, topping out of the market started, you might have been on cash any which ways because you would have booked out of some of the themes then. Because as I see the last 1500 odd points, it's been the biggies and the really large caps which have corrected quite a bit. Reliance's, HDFC banks of the world. That the correction, of course, in individual pockets would have been severe, but at an index level, aggregate level, I don't think the mid cap and the small caps have corrected as badly.
Yeah, I mean, I think it depends. I think the sector, where the sectors in which there was huge appreciation, right? We had seen, stocks appreciating 200% and even more. In some of those sectors, we have seen deeper correction too. But you are right. The one way to respond to your question is when we look at the valuation of mid cap and small cap relative to large cap. They are sort of like 95 percentile. In other words, only 5% of the time that historically their valuations have been at a higher discount than large cap compared to today. So you are right in broad sense that they haven't corrected as much. And one of the things that we have also done is been a little more careful with mid cap and small cap, in especially taking new positions. Because we know that if there is a deep correction, then it is then those stocks can take a very, very long time to kind of recover. So that has also been a bit of a conscious call here.
Yeah, no, the point that I was trying to drive home is that your sitting on 15-20% cash seems to be more a factor of valuations of individual holdings as opposed to what the market could do. And therefore, I was trying to drive home that point. So please tell us, Bhavin, in what, within your sectoral holdings, or not getting individual stocks, by the way, you may use them as illustrative examples, but nothing out here is construed as a recommendation by any fashion whatsoever. Where is it, on what themes have you found, or did you find that the valuations were egregious and you booked out? And which themes, for example, are continuous themes, and the only concern was only the valuation, which may have corrected a little bit now?
Yeah, so the very aggregate, very aggressive valuations, aggregate valuations, as you put it. I think we have probably not even entered some of those sectors. I mean, I think look at some of the IPOs, that has happened in consumer internet space. We have just not entered that space because we just couldn't digest what market is kind of factoring in. Even traditional sectors, if you look at specialty chemicals and chemicals, I think whenever the business in market found the business to be very good, valuations were very expensive, even from a long-term perspective, in our view. So we have not entered. But having said that, in our portfolio also, for example, IT, we had pretty high exposure to IT services, and we went into that kind of in like the COVID correction timeframe, where we found some great value in the sector. And then over time, we have seen earnings estimates have went up, companies have delivered better results, and outlook has also improved. But I think the kind of extra so the long term story has definitely on the margin improved for IT sector, but not to the extent that the multiple expansions would justify. So today we are paying anywhere from the biggest IT stocks are trading at 30 to 35 times earnings, and mid cap, small cap, and as you look at if the business looks very interesting to the investors, people are paying any multiples, 50, even 100. Now that is clearly a case of I think exuberance, irrational exuberance, as as some people have said before, and so we have definitely reduced our exposure to that sector. And we understand that the earnings story, I mean, especially the revenue story, may be very good for next a year. Some people are saying 3 and 5 years, but at least I think it's fair to assume year. But I don't think there are the room for margin expansion or margin surprises there. If anything, there could be slight disappointment unless rupee depreciates. So I think all in all, it seemed like a case of time to reduce the exposure. So that's what we have done there.
Okay. Can I know you mentioned that you haven't taken part in any of the new age tech themes as well. But when I look at the recent performances, say a Nykaa has hardly budged from the highs. Zomato, for example, which has now had some history behind it, has not corrected despite the fact that the markets have come off. Um, what gives here, Bhavin? Would you be I mean, if you were to be a buyer, would you be a buyer at a right valuation? And if so, what are the right valuation levels? I mean, a multiple and the level that you would probably look at or be comfortable with when you look at these businesses.
So I think the we look at we don't mind looking at very long term outlook for these companies, uh, even if it means looking at an opportunity spread over next 20 years or 25 years. We don't mind trying to understand what is that opportunity. In fact, we have created a macro model for India, where we said, okay, India is at to $2,100 per GDP per capita. What is it that India can achieve over what period of time? What are the parallel examples from China and other markets? And and we have also tried to kind of put in that equation the GDP, the demographic story of India. And when does the working age population start to decline? So which means lower growth because of that factor. So all in all, we don't mind looking at all this from a very long term perspective. But if after doing all that, if our expected return does not meet our criteria, which is that if it's a very stable business and in a large cap, a liquid stock, then we want 10 to 12% return. And if it's once you relax those two variables, our return expectations go up to as high as 20%. So if it doesn't fit into that, then we don't invest. So to be honest with you, that price for some of the names you mentioned would be less easily less than half or even lower than that from current prices. So for us, yeah, they are not. I don't know when they will ever get in our zone. But the interesting thing is that even though, I mean, that has been the story for us also with some of the consumer stocks in the past, not the consumer internet, but traditional consumer stocks, FMCG stocks. But even in spite of not owning them, we are able to think deliver performance, because I think the market gives opportunities in many sectors. I
Yeah.
think give you a recent example, Escorts. I mean, I think we have been invested in that company for quite some time, and even today. And I mean, the recent event announcement is just like an additional uptick for the stock. But it looked like a very strong business, company gaining market share in a sector. And I think while dependent on the agri economy, but the outlook for agriculture, was pretty good for last 2 years, and even this year, given the rainfall, and market seemed to have sort of stopped, started to ignore that stock. It had done nothing for a year. So we do find such opportunities from time to time, and when we do find them, we invest aggressively in such names. So that is how I would, so for us, it will be a while before you know we would get into the stocks you mentioned.
Okay. No, I was just trying to get an assessment. So let me ask this to you. Let me flip the question on its head. Where is it that you have found the opportunity to invest aggressively, or where is it that you've not reduced your holdings and will not look to reduce the holdings even if the outlook for the market worsens because the individual story of that business or that theme looks very promising?
Yeah, so I think you mentioned HDFC. I think even the financials have corrected, the banks have corrected, and we do have exposure to ICICI. And we are not looking to reduce; we are looking to increase, because we do believe that when there is a lot of this talk about technology and fintech, I think there are established players like ICICI Bank, which are actually riding the technology wave very well, better than their peers, and as a result, gaining market share as well in some product categories. And I think that will continue, because once you put once you get your technology right, or vice versa, you don't get it right, which I think is the case for HDFC Bank. I think the opportunity for you to take advantage of that can last multiple years. And I think ICICI Bank is in that spot. I think historically they had some technology advantage, but they had bad credit culture. which I think resulted in what happened. But I think what they have been showing for last 2 to 3 years is a clear improvement in that aspect. So if that continues, it could the company could grow at a much faster pace than the banking sector. And I think so we would continue to stay invested and even increase the position there. So yeah, so I think even in chemical space, there are names which we think have fundamentally very strong growth outlook, especially with new products and so on, and where execution record is very strong. So we would stay invested in such names as well, even if the market corrects.
That's a very interesting pocket, Bhavin, because it went up, almost everything went up together, and most things have come off. And in certain cases, it's not just the very expensive new listings, but even some of the not so expensive spec chem names or chemical names which have a spec flavor to themselves, if not the entire portfolio, but valuations were attractive. A bunch of those have corrected too. And we've also had the cheaper chemical names like Tata Chemicals, which were in the fancy for the EV push, also correcting quite meaningfully in the last few days. How do you go out? Let's assume that the growth story in the sector is not dead. How do you approach the space now? Because the valuations have come off in almost everything, but even after this, some are still frothy, whereas some have become a lot more reasonable.
Yeah, so I think that's where we have to do more work. That's where the opportunity is there for for investors like us to look at every company and see where the growth outlook is. Fairly. Where we have high conviction in the growth outlook, because I think most of the chemical companies have kind of announced pretty strong expansion of strategies. So we have to then develop conviction. We have to understand where the earnings are not inflated because of temporary factors, such as a rise in some of the products prices in the market because of shortages and supply chain disruptions, and so where it is more sustainable, and where the execution record is very strong, because when you talk about expansion, ultimately it's about execution. It's about setting up new manufacturing and delivering the products and to the market, and it's not as simple as it sounds. And so all these things are important to us. And finally, after doing all that, again, as I go back to the same thing, can we generate expected return that will exceed our required requirement? And then only we would invest. And I think I can tell you that while you talk about correction, I don't think correction is deep enough for anyone to just go and buy the entire basket. I think that I don't think is the case. I think there's still very high multiples on a lot of stocks. I feel.
No, I second that completely. A couple of other things, Bhavin. After a long slumber, Telecom seems to have woken up. There is now ample evidence of that price hike that everybody was talking about. Is this a game-changing thing? Because the last time around that the whole street turned bullish on Telecom, the sector tumbled for the worse. What's your thesis on this, if you have one?
So I think the suddenly looks like a better situation for the sector going forward compared to, I think, maybe last 7, 8, 10 years. I think the potential for a big new entry looks limited. But having said that, this is a sector, these are companies which will have to do still a lot of investments, right? There is 5G, investments that are coming up, and so and there are competing technologies also. I think fiber is really doing fiber. A lot of people. I mean, I think especially if we talk about what happened during the pandemic and last 2-3 years is that a lot of people relied on the cellular connection for their primary data activity. But I think that is in my view a temporary, because ultimately much higher bandwidth can be delivered through kind of a copper or a fiber to home, and that I think will continue to expand. And I think so for the telecom to do well, they will have to invest in 5G, and so ultimately that puts an upper lid in my view on what appreciation you can enjoy in the stocks. And that's why we are not chasing that sector. But yeah, I think sector looks a little bit in a better shape for sure.
Okay. Are you an investor in metals at all in any fashion?
I think we invested for a short duration in metals in post-COVID, and then I think we did not stay with it too long because there were far too many opportunities to invest, and we felt that this is not an area we want to really put our energy in. So yeah, not today.
Not today. Okay.
But never. But I won't say never again. It's not like a.
Yeah,
If the opportunity is interesting, then we would, yes.
Sure. Okay. My final question, and that is on a sector that everybody seems to be bullish on, but the tailwinds also seem to be in place, and which is real estate. There is almost nobody on the street who's believing that real estate mein mandi hoga. Everybody is saying that the times are looking good. Are you in the same camp? Why or why not? And what's your thesis on what some of the realty companies can do going ahead?
So I think I am with the idea of being bit more bullish about real estate sector because it has been in a slump for a very long time, and ultimately it's that there's obviously there is certainly considering our population, our demographics, there is definitely going to be that demand for housing. That maybe there's some catch up has to be played on that front, and there's a lot of pent up demand. I can understand that, and obviously the interest rate environment is also a little bit more conducive to that. But I am not in this camp of major consolidation of into a few players on a national basis, because what I'm seeing is that every market we are still seeing a lot of mid and small players actually doing quite well. I think real estate is not a sector where you're going to see like a massive consolidation like you might see in say paints or tiles or things like that. So that I think so I would approach the sector with an interest, but not getting carried away with it. So we have small exposure in that sector, not a huge exposure. Where we feel that the growth outlook, like for example, if you look at the Bangalore in particular, or some of the markets like Bangalore, Pune, where we are seeing such a big growth in employment in IT sector. So clearly there is a big support for real estate in those markets, and so if there is a way to play that, then one should think about that. So yeah, I mean, I think that argument could be perhaps expanded to a few other cities as well, but perhaps much more evident in places like Bangalore. So yeah, so we are trying to have some exposure through that, but yeah, I mean, so I think I'm kind of in between. I would say, I'm not like I don't think one has to be very bearish on the sector right now, but one should not also get carried away.
Before we wrap up, Bhavin, what's your biggest overweight? Where is it that you have the strongest conviction for the next couple of years? I'm not saying 6 months because that's too short a time frame for a portfolio manager like you.
I don't know. I mean, I think we definitely are. I think I mentioned ICICI Bank. I think we are definitely quite bullish on that name. I think conviction is also very high.
So banking.
So,
okay.
Yeah.
Okay, great. I mean, great having you. Thanks so much for joining in and keep up the good work. Wish you all the best with performance in the next 12 months as well.
Okay, thank you. Appreciate your time.
Of course. And viewers, thanks for tuning in.